Oil is jumping this morning. The United Nations Security Council voted to take military action against Gaddafi's forces. For more on what this means for the global economy, we want to bring in two guests. First, top oil expert. This is Jason Schenker of Prestige Economics. You can see him there. He's a Bloomberg best on oil for all accurate forecasts. He is joining us now live from Austin, Texas. And right here in New York, our friend Richard Falkenrath of the Chertoff Group. He's also a Bloomberg contributing editor. He's a former national security aide to President George W. Bush. Gentlemen, so glad to have you with us this morning. Jason, I want to speak with you. As we mentioned, you are a Bloomberg best, especially for your forecasting of oil prices. And you say even with all that is going on right now, we're not going to go higher than where we are now, which is 103 per barrel. Why is that?
Well, we think for the average price for the year, you're looking at a range that's going to be, for Brent, pretty close to that $105 in that middle 100 to 110 range. Could we go higher from where we are now? Absolutely. But the truth is we already have almost a $20 premium built into the price of crude. And the fact remains that right now we don't know how this is going to play out. Could it deteriorate worse? Absolutely. Is there any limit to the upside on price? Almost none. The asymmetric risks are still to the upside. But the truth is, with such a big premium already in play, if the situation comes to any form of resolution, you're going to see some of that premium come off.
Jason, I want to bring in Richard on this point, this idea that there's a potential resolution that doesn't shake the markets too much. The idea that it could get worse before it gets better seems likely, right?
Yeah, I think that is right. I mean, the oil price is responding not just to market conditions, but to geopolitical events, and they are inherently unpredictable, as we saw last night with a vote in the Security Council. And in my view, this means the situation in Libya is going to get worse before it gets better. The Libyan production will be offline for a protracted period, and there will be very unpredictable and complex consequences across the Arab world because of this intervention.
So, Jason, let's bring you back in on that point. I mean, Libya, as we know, it is the number 4 producer in Africa. It is an OPEC member. Let's just say Libyan production is taken offline for an indefinite period. Then where does the price of oil go?
Well, the truth is that where we are right now with prices is based not only on what's going on with current production, but future production. If you pull Libyan production completely offline or a significant portion, prices are likely to go higher than they are now. That's clear.
Can you quantify it at all, Jason?
Look, we've already had $20 priced in on where we've gone based on the risk that some of this comes off. Could it be another 20, another 30, another 50? It depends how bad the situation gets, and it depends where there's a spillover. Again, the asymmetric risks in this market, knowing where the price is going to go is almost more important than trying to guess, well, what if 2/3 of Libyan production comes off? What if 1/3 comes off? The truth is we want to know directionally where's the risk. The risks are still to the upside. But if there's a resolution 6 months from now, 3 months from now, any kind of resolution at all, you could see the price come back down a little bit, which would leave the average price for the year kind of in that 100 to 110 range.
Jason, you mentioned spillover. Richard, just what does this mean to the other Arab nations? I mean, interestingly enough, it was the UN resolution and not the United Arab Nations resolution forcing this no-fly zone on Libya. I don't know, what would Saudi Arabia do? I mean, what are we talking about?
Well, Saudi Arabia supported the no-fly zone, the UN vote, and they clearly led the way. It was impossible for the UN and Obama to not be for a no-fly zone once the Arab League was. The most important spillover is with Saudi Arabia, who has already increased production to make up for the lost Libyan production. If for some reason they were to stop doing that for geopolitical events, or whatever other force, whatever other factor, that would be very bad. And one thing that might drive it is the imagery of civilian casualties in the Arab world, in Libya, coming from a Western airstrike. And that could fundamentally change the politics on the Arab street. That translates into changed oil production. That translates into changed oil price.
Richard, foreign companies, many Western companies, have a presence in Libya. We were just hearing from Lara Sertrakian on that. I mean, Italy's Eni, there's Repsol, Total, BP. I mean, it's a pretty long list. And Gaddafi actually said he's going to retaliate, right? First first of all, he's going to kick out the Western companies, right? And then second of all, he's actually going to retaliate in the Mediterranean region. What could this do?
As long as he's in power, Libya is a pariah again. And it's going to be almost impossible for these Western companies to do business there. Very, very difficult situation. The U.S. companies have already withdrawn most of their people. It's likely that the other Western countries are going to have to do that too.
Jason, back to you on that point. I know you said, there's a lot of moving parts here, but what if, for example, as Richard just talked about, the spillover effect, what other products could we see affected, not just the price of oil?
Well, the truth is, if there were a spillover, depending on how big the contagion is, then you could be talking about some sort of actually impact to global growth. But what Richard, he made an excellent point about the fact that Saudi Arabia still has right now tremendous spare capacity to kind of fill the gap of what's being reduced from Libya. And I think what's really at risk here, too, from Libya is the risk to natural gas prices. We've been talking about the risk to LNG prices globally because of what's going on in Japan. There's going to be an increased demand in Japan for LNG, and Libya also disrupts some of the natural gas production going into Europe, which is another big push. If there's further disruption in other parts of the Middle East, you could see a further push higher in global LNG prices.
All right, so watch natural gas, so watch oil. Jason Schenker, thank you so much, president of Prestige Economics, a Bloomberg Best Oil Forecaster, and Bloomberg contributing editor Richard Falkenrath, principal at the Chertoff Group. Thank you so much, gentlemen, both for joining us this morning.